the cynic in me thinks that perhaps the valuation will be a bit high on the ASX as a result of the success of these other companies.
Okay. So this is not one that you would be investing in today?
I think it's one that you could consider if the share price got really smashed out and down, but this has been a bit of a favourite of various different people just because there is an exciting blue sky story, and as a result of that, it's just probably too high priced for me.
Got it. Thanks, Claude. Let's get on to the companies that our audience has written in about. Morag is asking about M&F Group, My Net Phone. Look, Rudi, the FY21 result came in at the top end of guidance, but it is seeing a decline in some parts of its business. However, seeing margins improve. So how do you weigh it all up in terms of My Net Phone?
The M&F Group story is actually about selling the non-exciting, low-margin business, which they did, and then obviously keeping the higher margin, wholesale, more exciting part of the business. Because for people who are unaware, and not many people would be aware of this, because it's a bit of a funny company. I mean, if you look at the daily volumes in the shares, I mean, I always look at it and think like, how could small cap fund managers get in here? I mean, I guess getting in is easier than getting out. But the volumes can be really low on occasion. And that's, for me, one of the main reasons why I'm not in the stock. The other reason is that, and history tells you this as well, when a company like this sells the non-exciting part of the business, and so you do get higher margins for the existing part of the business, a re-rating takes place. And that re-rating has taken place over the past few months. So the share price has really trended higher. But that process now has run its course. And I think this company has not been performing according to forecast all the time over the past few years, and that's I'm putting it nicely here. They have had their share of disappointments. So I wouldn't chase it here, also because it is a relatively small company. If they do come out with a disappointing performance at one stage, the share price can get a lot lower, also because it is such a low volume stock. So I would here think that if you want to get on board, it's a bit late here for the time being, but it doesn't mean that they can't grow. They will probably grow their business further, but they will have to prove more here than simply sell the non-exciting part of the business.
Got it. All right, let's go to Claude on M&F Group for Morag. Claude, look, Rudi didn't sound overly excited about this one. Do you paint a better picture? More exciting future?
Definitely, yeah. So this actually has echoes of the last time Rudi and I discussed stock, and we had a good discussion, I think, with David at the time about the idea of a lobster pot, which is definitely what Rudi's saying here. However, that's probably true for fund managers and stuff like that. For a smaller individual investor, I've never had too much trouble getting in and out of the M&F Group, which I still own shares in to this day. Now, I'll give you the high-level reason of why I think it's an interesting company for people to keep on their watch list, which is that their international wholesale segment and domestic wholesale segments, which is the better parts of the business that Rudi was referring to. Well, the reason that the domestic part is a better business is because they're basically they're supplying the connectivity to all other like smaller telcos that want to start a little telco brand. And those businesses are typically not the best businesses, and some succeed and some don't, but they always pay M&F Group along the way. So as you have this ecosystem of competition and success and failure, M&F Group is always making money there the whole time. Now, the international stuff is also very interesting, not least because M&F provides connectivity or some sort of connectivity services to a lot of those large, companies, indeed, like Skype, if you're going to call a mobile phone from Skype, and also, I can't remember now, I think it's either Slack or Zoom, I believe it is, and some of these big players. So you've got a mega trend there that is going to continue to grow, allow them to grow this business over time. Of course, yes, it has had some ups and downs over the years, especially in those last 5 years, it's been quite bumpy. Now, I've held shares for that entire ride, would you believe it? And I've bought and sold a little bit along the way, and at the moment I have a fairly small position in the stock, unfortunately, I guess, because I think I took some off quite a bit lower than the current share price. But I still hold some just because I do believe that this is a really interesting, fairly high quality business that will perform well over the very long term. It's just going to be volatile along the way. Now, at the moment, I have to say that my expectation is that the full year result for the company may come in a little bit below where the consensus estimates are. And if I'm right, I think that these guys are going to disappoint soon on results. Now, I might be wrong, and that's why I'm still holding some shares. But I think that the share price has probably run a little bit ahead of itself. But either way, it's a good quality company, and so I'm not going to call it a sell. I'll just call it a hold.
Well, your money where your mouth is, and I don't expect you guys to agree all the time, or we wouldn't have a market, would we? Rudi, why are you laughing? Please explain.
I'm laughing because Claude's expecting them to disappoint in February, but he does hold the shares. Yeah. That's it having a double bet here. That's it having a double bet.
Well, no, Rudi's dead right, and that's why I was saying it's a small holding now. So that's sometimes what I do is if there's a company that I really admire and respect, but I just think it's overvalued, is I can't bring myself to sell all my shares, so I will sell out a fair few, and then I'll hold on to it, just because I want it to be front of mind. I write about M&F Group every time it reports, so you can find, if you Google my name and M&F results and stuff, you're going to find probably my view on it over the last few years, just because I think it's a great stock to cover. But I do have to admit to Rudi that yes, I do agree that it's reasonably expensive at the moment.
Reasonably expensive. That's good. What the takeaway is for you, Morag. Thanks, Claude. Thanks, Rudi. Remember, this is information only. It's not for your own personal circumstances. So you do need to do your own research and potentially get advice. Let's go to the next company on the list, Codan for Troy. And he's looking for a view because, yes, this market darling is now down nearly 50%. It's he's questioning whether it's looking cheap on forward earnings. Perhaps he's saying, are forward earnings in doubt? It has been dropping since the CEO. But Tony writes, surely the CEO retiring is not the reason for the fall. Claude, tell us what you know about Codan and your interpretation of why we're seeing the share price get hammered.
You dropped that slightly then, but I think I understood what you just asked. And so Codan, I think we were talking about this not long ago, or I was anyway, with you. And I think at the time I was saying I've underestimated it consistently, right? But I still couldn't say, oh, it's going to be fine at the prices it was trading at, which was close to the highs there. So I think reality is with this business is it's not a recurring revenue business. It's not a software as a service business where you can probably expect that in a bad year it'll stay flat. It does, have to sell its top end gold detectors, which are high margin things, and as they have a good boom in demand, they get operating leverage. Their profits go up massively, and then the market can extrapolate that, and that's how you get that massive share price. And you can even see how in the past they've had these run up and then it comes down, run up and then it comes down. And that is the cyclical nature of this kind of business. When you have a good season, when you have great demand, the operating leverage kicks in, you make high profits. When that unwinds a bit, profits can go down again. And that's why you get this these big drops and these big rises. Now, for a really long-term holder, that hasn't mattered at all. They've done really well. And the reason they've done really well is that these guys clearly have fantastic IP in their gold detector business that makes them able to sell, premium equipment at high margin. And I don't think that that's changed by the fact that the market, isn't as excited about the near-term future, which is sort of my understanding of why the share price came down lately.
Yeah.
Although
so Claude, sorry, I'm just going to move us along a little bit. Is then this price fall, your opportunity to get into this company that you completely underestimated in the past?
Well, it might well be, right? So it's definitely one on the top of my watch list. I haven't formed that view yet, no, because basically this only started dropping a couple of days ago in earnest, right? And it's been on a bit of a downtrend. So there's no rush for me, because when you have these cyclical things, it's not like there's a sudden buy the dip and it rebounds. It's like there'll be a period, right? And we're going to wait for the next few results, and then if they disappoint, you can have the sentiment go lower. But yes, now is definitely the time to put this on your watch list. It's definitely on my watch list now. It's one that I'll be watching closely over the next year, let's say. I think, or even 6 months is probably when you're going to get the best opportunity, in my opinion. But yeah, I do still think that the long term, this business is a decent business.
Okay.
Let me try to get more than one stock in today's broadcast. Listen, I think everyone was scratching their heads because the share price had already come down quite a lot, and then it basically gets dumped. I've looked at the analysts who actually covered this stock. They were left mostly scratching their heads as well. But the suspicion is that they have been extremely cautious in their outlook, and the market has taken that badly, because when management is extremely cautious, it might mean, all else being equal, that they know more internally than we know on the outside, and maybe things are not that fantastic. Their outlook implies that all the growth for this half comes from acquisitions. So organically, zero growth. Now, some analysts think that management is being too cautious here, but nevertheless, that's what management has expressed, and that's what the market has taken as a negative. So if you believe that management is too cautious here, and that they will get new contracts, and that gold miners will continue buying their equipment, then of course this would be a buying opportunity. But I think a sidestep as well, the reason why I sometimes say be careful with some of those small cap stocks is this is particularly the reason why. The company hasn't done necessarily anything wrong, but the share price is down a lot. And that is the risk, unfortunately, that you run with companies of this size, because if this were, let's call a few other ones, REA Group or Car Sales, it wouldn't be down this much.
Okay, so would you look at this opportunity or as a buying opportunity?
Since it's down that much, I would, yes.
That's a buy coming from Rudi for you, Troy, uncoded. Oncosil Medical, OSL, this is for Eliza, Claude, global medical device company focused on oncology. So it's microparticles to be used in combination with chemotherapy. What do you think of Oncosil and its opportunity? So
I guess that there's so basically, good on these guys. They basically have a business where they're trying to improve outcomes for pancreatic cancer patients by getting phosphorus right in there to help them defeat the cancer. Look, they're moving towards, I guess, being able to commercialize this device, but as a result of that, they're still extremely high risk. So I guess I can save a little time on this one by just saying I actually don't have the technical qualifications necessary to have any ability to understand whether this is a treatment that doctors will prescribe. Because remember, there's one question is whether they're allowed to sell this thing. And then the second question is, are doctors going to go for it and tell their patients you need to use this? And then you have the question of whether they can make money and how much. So I can't do a risk weighting of whether that's going to happen, because I don't have the medical science background to understand this. So for me, it's just easy to avoid this, because there's no advantage I can have. I can't add any insight, and neither can most people. And you get a lot of these, companies that sell the dream, and then the person buying the dream has no idea how to value that dream, and then they can overpay, and then they lose money like shareholders have over the last year. So I will avoid it for that reason. Not saying it's a bad company, it may well succeed, but I'll be avoiding it until it gets some success.
Chart's not looking great though, Rudi.
No, I thought, at what point am I going to point at the chart? Usually, when you see a chart like that, it doesn't mean it's a great investment. The other thing that Claude accurately says, it's extremely high risk. Also because the track record in the past has been one of disappointments, of board upheaval, of delays in everything that they've been doing. It doesn't mean that you can't put a high risk proposition like this in your portfolio, but you have to realize it's high risk, and you have to realize what moves the share price, and that is further progress on everything they're developing. And on the outside, we have no control over that. But I would in general think a share price chart like that, for me, it doesn't excite me at all. And I would, from experience and from observations, I know that more money goes lost in the share market in trying to put some money in those stocks that don't look great at all, and then keeping the fingers crossed and hoping for better. There are easier ways of making money in the share market.
All right.
Much easier.
Too hard basket is what I'll take away from that one. Let's get to the next company on the list. This one is for Ben. Thanks, Ben. I hope you're listening or watching. IOOF Holdings, IFL City, I think today is out on, I'm going to you first, Rudi, there's your hint. Upgraded it, says that there could be potential further synergies coming. Lots of moving parts. It says it's quite a complicated picture when it comes to IOOF, which we know. But said there might be some long-term value if you can look through the short-term noise.
And that is probably accurate, but I can't get excited about this one.
Not even if it changes its name to Insignia Financial?
I know, exactly. No, there's probably a reason why they want to change name. It's like Facebook. They want to get rid of all the bad press.
Meta.
They want to get rid of all the bad press. Listen, this is a sector where you have essentially two great performers, Netwealth and Hub24, and they are literally shooting the lights out. Both management teams think they have at least 2 to 3 years of ongoing very strong growth. Then the only question then becomes how much do you pay for those shares? But thus far, shareholders are literally sitting on a gold mine. This is the value proposition in the sector. Right? For people like myself, very unexciting. It would score very badly on ESG and because it has quite a questionable practices that at one stage got
at one stage, got
to the fore, and Altman as a stockbroker is out now. The one thing I think I need to point out here is that they did buy MLC from NAB and they did buy the activities from ANZ Bank. Now, in particular, the ANZ operations, they were not, putting it very mildly, they were not the best performer in the local funds in the industry sector. Those businesses do not become all of a sudden great businesses because they have a different owner. So I'm not surprised that IOOF management constantly has to tell the outside world it's going to take longer, and yes, we are losing funds and we are losing advisors, and that doesn't come as a surprise to me at all. So it may well be that this is a value proposition, but I also think that people banking on that might have to be patient for longer.
Claude, is this a father-in-law stock if you look at value and its long-term prospects?
Not if you love your father-in-law. Everything Rudi said is exactly correct, except he was too nice as usual, or at least as usual about the big companies. He saves the real digging in for the little ones. But
those would be fighting words if you're in studio, I think, Claude.
No, look, he makes some great points. All I'll add is, I think I was reading their recent update, and, of course, they're talking about their funds under management outflows, and then there was the somewhat forlorn statement that in one of their businesses, outflows were looking at, they were showing signs of stabilizing. That is just definitely not what you want to be reading about a funds management company. If they're getting outflows, it means probably that they or their clients feel that they're not getting good value for money with that funds manager. And the way that this usually works is if one person's not getting good value, then probably no one is. And the reason that doesn't immediately end the business is because everybody will have a different tolerance for not getting great value with that fund manager. So some people will do it straight away. Some investors are long gone from these guys. Others are taking longer, but the trend is clear. So it's definitely the antithesis of what I look for. I look for growing companies almost exclusively when I'm investing. So that's a hard no for me.
Hard no for IOOF Holdings. Ben, take that to make of it what you will. Last one before we have a little bit of a reset and take a look at the fantasy portfolio is Reliance Worldwide. Talk about a market darling. I mean, it's updated just recently. It's had broker upgrades off the back of that this week. I believe that the share price is up yet again today, one of the better performers out there. Seems to not be able to put a foot wrong, Rudi, because of demand in the US, even Credit Suisse for one, saying that margin compression will persist due to cost pressures, shipping, freight, energy, raw materials, but it still hasn't outperformed on the stock.
Yeah, when you say it can't do anything wrong, that is for the moment. For memory, I think this one has been listed 6 or 7 years, And it has already, over that period, had quite some volatile existence on the stock exchange. It's extremely cyclical. That's the word I was looking for. And it listed with the promise that it is a disruptor in this particular industry. It's an innovator, and it quickly moved into Europe. But we should all realize it can be itself disrupted quite quickly. We only need a very harsh winter, and all of a sudden the numbers will disappoint, which has happened in the past. So treat it with caution, I would say. At the moment, yes, everyone thinks that in the markets where they are active, the renovations will continue. Housing markets are on a high. Reliance has done some acquisitions, have paid off. Apparently management is doing a better job here. But I still remain a little bit cautious because of the cyclicality. It's a small cap stock, and not everything has gone right in its short existence as a listed entity.
Well, cue the emails saying that the guys are too negative today, because of course we're in a cycle. We're always in a cycle. You can't ignore cycles. There's ways to make money in the cycles, isn't there, Claude?
Yeah, so there's always something that you should be buying. So Reliance, just in case people don't know, they're doing mostly plumbing stuff. So that's why, as Rudi mentioned, if the renovations and the home building and stuff goes strong, then these guys should do well. And I think it's worth keeping in mind that there is a sort of moat there, just because building up the distribution network to get your products out there is like a barrier for entry for some other large scale players to get there, because there's going to be disadvantages for smaller people who don't have an established distribution network. So, it's like definitely investable in the sense that it's probably leveraged to something for which there's going to be long-term growth, which is like building more houses and stuff. And then it also, has a bit of a competitive advantage. So that definitely makes it a reasonable company to look at. And right now, obviously, it's had a bit of a share price run. It is going to have its ups and downs, just because demand in those sectors are going to have their ups and downs over time. Some would argue the housing market in Australia is running pretty hot, but, it's got exposure overseas as well. And so, or rather, it's mostly in the US, so I'm not sure it matters in Australia, but, you do have some exposure if there's a housing market crash in the US again. So something to keep in mind anyway. And but aside from that risk, I would say that it looks pretty reasonable here. Perhaps the dividend yield is a little bit lower than you'd want. I think about 2.4% at the moment. It's probably a little bit lower than you'd want. But yeah, I think it's actually kind of reasonable, decent quality business. It hasn't really done anything impressive though. And I don't see any reason why it will be impressive, and it's not particularly cheap. So I'd call it probably a hold. And maybe this is more of a father-in-law's stock that would be worth considering as well.
Okay, thank you guys. Thank you for that first half. Let me just run you through what we've learned. Frontier Digital Ventures, quarterly update strong, but not enough to convince either of my guests today to buy it. Rudi would prefer to buy an REA Group or a car sales, although, it's still not cheap, but it's got strong growth going forward. MyNet Phone Group for Morag, it's a hold from Claude. He is a holder of a small parcel of shares. He does, though, believe that it's a high quality business, could be a good long-term holding. Rudi just says you're late to the party, and the company's not been very well performing over the long term. It's a low volume stock, just not appealing to Rudi. Coden, so why is it so cheap? We tried to answer that question. Rudi says perhaps management is being extremely cautious in its outlook. It's pricing for zero organic growth going forward. Rudi says at these levels, it's a buy. It's not, though, for Claude, although it is at the top of its watch list. He'll be watching it for the next, say, 6 months to a year before he would decide to get in. Now, Oncosil Medical, it's that same old story we hear often with biotechs. If you don't understand exactly what it's doing, perhaps you should avoid it. So it's a no for Claude. If you do want to get into biotechs, though, and you'd like to know how to value them, we are holding a special event here at ausbiz next week in conjunction with the ASX. Go to the website. You'll find out ways to sign up for that, because, I had a really good chat with an analyst earlier this week who had me pretty convinced there are great opportunities in the life sciences and biotech space. And it's a mistake to just put them all in the too hard basket, which Rudi is doing with Oncosil. He says It's extremely high risk. There are better ways to make money out there in the stock market, and that's what he thinks about IOOF as well. Yes, perhaps there's a value play here, but he says that look to Hub24 and Net Wealth, how well they're doing. They still think they've got a couple more years of pretty strong growth. So IOOF just cannot excite Rudi. Claude says Rudi's actually being too nice in his assessment. You can go back and listen to it again. It's at best a hold for Claude. Number 5 on the list, Reliance Worldwide. More excitement here from Claude, potentially even a father-in-law stock. It's a hold for him. It's not for Rudi. Too cyclical. It's a small cap. It's doing well for the moment, but look, it's not as if it hasn't done anything wrong in the past. So bah humbug for Reliance Worldwide from Rudi Filapek-Vandyck from FN Arena. Let's get to the portfolio, shall we? Our partner NabTrade is to thank for this. All the companies that get 2 thumbs up or a buy on the day from both of our guests goes into the portfolio. If it gets a unanimous hold and it's already in, it remains there. Let's check in on performance. Down this week, up over the month, close to 3%. From July 1st, up by close to 17%, but from its inception, July 1st, 2020, up by 44% or roundabout there. Lately, we have put in Smart Parking, Vanguard ETF, Total US Market Shares Index, Alcidion Group, It's a Biotech, Clinivel Pharmaceuticals, and Phineas Corporation. I think that might have been you guys that put that in. Maybe I'm wrong. Stocks removed, and no big surprise. And this happened before. The bad news this week, A2 Milk, Crown, a bit of news out from Crown today, not admitting liability there, Star Pharma, and PointsBet. PointsBet, last I checked, was the worst performing company today. Let's get back to it. If you want to look at that portfolio, you can do so via that email or the URL at the bottom of your screen. Boy, I haven't said that in a while. Stay with us. Oh, no promo. Let's get right to it. Hansen Technologies is the next on the list. This is for Michael. HSN is the ticker code. Claude, I'm going to start with you there. What do you make of Hansen? Because it had a private equity offer on the table, which was pulled. Was it a problem with the company? Does it matter, to shareholders? Are they potentially better off, remaining as a listed company? What do you think?
I'm not entirely sure the true reasons why the offer was pulled, but I would have... Look, I think that the results that they've reported recently were very strong, and I think that this is a good quality business. And let's just talk about why I like it as a business, and then I guess the question is whether I like the current price. So what Hansen does is it has it's a roll-up of software companies, and it has a particular focus on software that I guess is close to where the money flow is. So they do a lot of billing software and allow from anything from like telecommunications companies to utilities and that kind of thing. And so you can imagine that by having to do with the billing or the customer interaction and managing those customer accounts, they become very sticky within the technology stack of those large, usually often infrastructure style companies, because if those companies were to try to change that, and they might have a disruption and that will affect their collection of the actual money. So it's a high risk, potentially low reward activity to replace Hansen. And obviously, because they're in this particular target niche where they want to be close to the money, it's actually hard for them to organically win customers as well. So what they tend to be doing over the years is they've been purchasing other companies in order to drive their growth. Now, if you'd asked me about a year ago or more about what I thought about this company, I would have probably been quite negative about the fact that it had to acquire growth and it didn't have really strong organic growth. That said, it does have modest, usually single digit organic growth, so that's not too bad. But what we've seen, I guess, in the more recent years is that the current CEO, I think, who is the son of the original founder, so this is an old school family-run company, basically, he's really I guess, putting more of an art onto the acquisition process and the Hansenization process, as they call it, which I thought it was a bit funny to say that. But it actually shows that they've got a lot of pride in their activity of rolling up these software companies. Now, that sort of brings me to thinking that actually maybe they're onto something here, because if they're consistently creating value with these acquisitions and they think that they are, and at least some of those acquisitions have gone on to clearly grow profits, then maybe they're just going to be creating value by rolling up these software companies, which is arguably less risky than rolling up dentists or lawyers or whatever it is, because it's the software that keeps the client with you, right? So it doesn't matter if the software developer leaves, they're going to retain the client. That's a bit different for a dentist or a doctor or the professional services roll-ups you see, where the customer will often follow the individual. So for that reason, I actually think that I've probably been too harsh about their acquisition strategy in the past. And yeah, I quite like the company. Now, it's trading on a less than a 2% dividend yield at the moment. And, that's not great and that's not super attractive, but certainly, if it were to be trading on a 3 to 4% dividend yield, I reckon I could make a good case for buying it as a more conservative dividend growth stock. And even at current prices, it's not too bad at all. It just doesn't offer that obvious margin of safety for me. So I'm sorry if I come across negative. I like this company. I'd probably call it a hold, although I would be closer to buy than sell. I think it's actually a good quality company. I like it, but it's just pricey. A lot of
got everything in there. Okay, so pricey then. Rudi.
I'll make this one much shorter because I'm also well aware of Hansen. I'm less enamored. Everyone always says it's a quality business, but in the past it has had extended periods when it simply cannot grow. So yes, it has sticky customers, but the customers make sure that they get the benefit above anything, and it doesn't always translate into benefits for the shareholders of Hansen. And they need acquisitions essentially. So as long as they can keep feeding in acquisitions, that model can sustain, and they can continue to grow their dividends, which they are now projected to do. So it would appear that now let's say spring has arrived at Hansen after they were basically in winter for quite a while. So for the time being, it would appear that enthusiasm of Claude may well be accurate here. But I also can't go past a hold here. I wouldn't chase it, and I would actually argue that I disagree a little bit with Claude on the growth strategy. If you really want to have a lower risk strategy, I believe, then you go for a company like, for example, a Technology One or an Objective or even a Zero that can grow organically without having to buy other companies and then integrate them and then make sure that you get new customers.
Okay, I'm going to say bonus buys Technology One, Objective Zero to keep the masses happy. Whoa, and I wouldn't be chasing Hansen here. Now, Airtasker for Ryan, no broker coverage.
No.
Rudi.
Too small.
Look, it has been some pretty decent results, even though we've had Sydney and Melbourne locked down. Would you buy an Airtasker?
I have like a whole truckload of question marks for a business model like this, and I mean it's for me. No, and I don't. You don't need to be in here. I mean,
okay.
There are less risky propositions.
Ryan, there's less risky propositions according to Rudi. What about you, Claude? Would you be buying an Airtasker?
No. It burned $5.5 million in the last quarter on, I think, 6.5 million receipts from customers. So money is going out the door at like twice the rate it's coming in the door, and this is hardly a immature business. And I think it's just the same. It's actually got a similar story as what's happening with Frontier Developments. Is in this country on the ASX, we really love any kind of network effect business or two-sided marketplace kind of businesses. But the quality of these businesses have, it's a huge range. The highest quality ones that just keep on going up and up for decades. The lowest quality ones may struggle to ever make money. I'm not sure exactly where Airtasker fits, but I think that it's not actually that valuable. I think that most people who are doing repeat work through Airtasker would take it off the platform. I know that there's a bit of debate around this, but that's my view, and I just don't think it's a particularly high quality business.
Got it. Now, Claude, the next one I'm going to start with you, ACL, Australian Clinical Labs, because I know you like it. So then let's get to the question, which is, what do you think, and this is for Fran, at this current price?
Well, I've got a bit of a nuanced response to this, so I'll try to be as quickly as possible. So first of all, what I think at the current price is that it's probably undervalued. I think it's probably cheap. But what you have to remember is that there are two ways that you could approach this company. One is, this is a pathology provider. You want to be a long-term holder. It looks very cheap at the moment because we've had a massive, spike in COVID testing volumes. But at the same time, most people are now expecting that the COVID testing will start reducing massively, which will definitely mean less profits for Australian clinical labs. Mm-hmm. Now, having said all that, I still think this probably looks pretty cheap long-term because I still think that the base level of COVID testing finishes up higher than what the market seems to think.
Yeah.
Now, that's one way of thinking about it, but that's not really the most exciting thing. Now, I did previously own shares in Airtasker, in Australian Clinical Labs, not Airtasker. And if we look at the 1 year chart, you can kind of see how in July this year, after we had the outbreak happening in New South Wales, even though we knew automatically that there would be a ton of COVID testing, it actually took a while for the Australian Clinical Labs share price to respond to that very obvious fact. So what I did was I jumped on that stock and started buying it as much as I could in below $4. And I said to myself, look, I'm just going to, or said to everyone, I'm going to hold this while cases and testing keeps going up and up. And what I've done now is I've sold because we saw that process ended, and now obviously things are getting better, at least in the short term, and it seems likely that there's going to be less testing going forward. So I've played out my trade. My trade idea worked. It was good, but I still think it's a fairly cheap stock.
Okay, well, that's an interesting one because I heard this week that Coles and Woolies, Rudi, will be offering rapid testing.
Oh, well,
you can just go down to the supermarket and buy tests.
There you go. But my word would be unsustainable. And the same happens with Helios, and the same happens with Sonic. We have to realize that those companies have had a jolly good time because we had so much testing going on.
Yeah.
And all else being equal, we know this, we are going to be less testing. Now, my argument would be that for a small cap stock like ACL, it's going to be a much larger impact. And I think the market will be very cautious here, and the potential impact can be quite large. Now, whether they longer term can build the business with which they're listed with ex-COVID, it's probably valuable proposition. But for the time being, there is that question mark about how much will volumes drop, and if it is a little bit more than just a little, share price can respond quite savagely. So I would be saying be cautious.
Be cautious. That is not a buy. Now, Sezzle today, one of those BNPLs listed in Australia. Most of its business is in North America. It came out today growing its income by 78% over the third quarter to $28 million US, 44,000 merchants, underlying sales rising by more than 100%. Rudi, every time these BNPL plays come out, the numbers and the growth are astounding. Not profitable.
Yes, but we should also realize that's because they come from very low numbers eventually.
So
it looks all fantastic.
What's your biggest concern when it comes to I don't want to put words in your mouth, but what would be the big risk in investing in a Sezzle?
That they don't have a long-term business model, basically. And the markets, you can tell this, we would all see a lot more if it wasn't for an acquisition hanging over the Afterpay share price. The market's view on this whole sector has changed. We now are all aware that it's not just a land grab for everyone. Now this sector is changing. The big boys are moving in, the banks themselves are moving in. Afterpay will be acquired by damn it, the name escapes me. Square, that's the name. And we will have PayPal in that sector. It's not going to be a free-for-all. And businesses like Sezzle may never be profitable and may never get more than just a tiny little market share, which basically means there is no future for those guys. And that's what is reflected in those share prices. So I basically, my favorite observation is when you go to those new emerging tech sectors, you choose the number one or the number two, and you don't go further down the line unless you want to do a short-term trade.
Well, that's the question. So this is for Tony. He didn't give us any details as to how he's potentially viewing the stock. But Claude, is there potential to make some short-term money, even if you don't necessarily agree with the fundamentals? Look at Afterpay.
So I think probably there's not that great potential to make short-term money off Sezzle, although I couldn't really tell you with much confidence because I can't predict the hype cycle that happens with some of these buy now, pay later stocks. But I think I came on, and we've talked about this before, perhaps in April, I think it was, and, I was calling Sezzle a sell then, and, it was my view then, as it is now, that this remains probably one of the worst quality buy now, pay later companies on the ASX. Now, don't forget, most of their business is in the US, and if you search for Sezzle and vapes on Twitter, what you're going to find is a lot of tweets about people, asking if Sezzle has stopped supporting vape stores in the USA, because that was sort of something they did before. I've seen lots of research that suggests that a lot of their internet traffic was coming from anime porn vendors as well.
Oh.
And I don't know if that's true, but I've certainly seen from SimilarWeb, Sezzle gets traffic from an anime shop there. And so, I just sort of wonder about the quality of their customers to a degree there. So, for me, I'd probably avoid it. It's probably not as bad now as it was at $8 and $10 and stuff, but it looks just like it just deals with a high risk. This is why it can charge an interest rate, right? It has higher risk merchants. I think that's an agreed thing that we can all just face up to. So it depends if you want to have that extra level of risk on top of the normal risks you're taking with loss-making buy now, pay later.
Well, your verdict is avoid it, so we'll go with that, Tony. This one's for Jason, the ASX. I'm going to start with Rudi on this one. Claude's our producer, and that's because the brokers are really split on this one.
Yes, and it really comes down to the fact are you approaching a stock like the ASX on very traditional metrics, and you just put a valuation on it, and you think like, well, it's expensive. And I could replace the ASX here with REA Group and with CBA and with Cochlear, and they will all say the same thing. It's expensive. Yes, it is expensive, but it's expensive for a very particular reason, and that's why value investors never get these stocks. The reason why the ASX is being highly valued is because the world in which we live, low inflation, low bond yields, low growth, and very short cycles. A company like the ASX, try to do business with them. If you are a website or a service or even a fund manager or whatever, they make you pay. And you can beg for a discount, but you won't get it. And that's because you can't get your data elsewhere. The ASX simply says, this is our price and this is what you will pay. So it has an incredible strong pricing power, which what a lot of other companies don't have. In the current context, if you are that strong in pricing power, you will get a premium rating on the share market. Unfortunately, that means that your yield is lower than historically, and the share price valuation is higher than historically. Now, what puts the fear into people is like, oh, what if the premium disappears? You know what? Again, I could go 10 years back, REA Group, Cochlear, CBA, the premium tends not to disappear in those really high quality stocks that keep their market share. I think the ASX will be expensive forever and ever, and you just have to pick your point. If this is the kind of stock you want in your portfolio, at what point do you feel comfortable to add that to your portfolio?
Are you comfortable to add that today to your portfolio, Rudi?
I would say hold. I would say hold, because if you own it, you wouldn't want to sell it. It already has come down quite a lot this year, but there's no reason to get rid of it either. This will remain a strong company in its right.
Classic definition of a hold. Claude?
Yes.
Look, yeah, Premium used to be a monopoly, is not quite anymore. Chi-X was just bought by SIBO in the States. You know, like, how do you view the ASX when fundamentally, if we have a lot of IPOs, if we see a lot of capital raisings, which we have done, it will be, you know, beneficial to its business?
Yeah, so it definitely is going to be pro-cyclical in that sense. If we have buoyant market conditions, then ASX will do well. So maybe that's a trade idea. To buy when the things are looking bad, right? If that's the thesis, you want to buy when everything's slowed down, and then ride the uplift. In terms of, I guess, what its, you know, strong point is, it is really a we'll call it a quasi monopoly asset. But the problem with a monopoly asset is that means that it may not have invested enough in innovation and in website improvements and stuff like that. So I think that it does leave it a little bit vulnerable in terms of it probably has more to lose than it has to gain here. And it's questionable whether it's invested in the right areas to make sure that it is a competitive an offering as it could be. So for those reasons, I wouldn't call it a buy. I think that there's probably a little bit more risk than people realize there. But at the same time, it's just hard to argue against that near monopoly status. So that gives it a lot of resilience as well. So as a result of that, I'd call it a hold.
Okay. Well, that's great, guys. That brings us to the end of the program. Claude, I'll say goodbye to you first because you're joining us remote. I hope you have a really good weekend with the fam. We'll see you soon.
Thank you for having me. Have a great weekend.
You too. Rudi Filapek-Vandyck from FN Arena. Nice to see you in the flesh, and nice and shorn as well for this 32-degree day.
They still lowered my chair. They still lowered my chair.
All right, Rudi, we'll see you soon. Thank you.
Okay.
A quick run through of what we've learned. Hansen Technologies, it's a hold for Claude Walker at Rich Life. Rudi says it's just he wouldn't be chasing it here. Let's say that. He would be buying quality. TN Technology 1, objective, and a 0. Airtasker is a no from both of my guests. Australian Clinical Labs, Claude has done his trade in that one. So that is how he has played it, although he still sees long-term prospects in it. Rudi says the days of rapid testing are here, and what we've seen for ACL is unsustainable. Number 9, Sezzle. It is an avoid for both of my guests. ASX, you've just heard them talking about it. It's a hold. That is our show for this afternoon. You can catch up online or via the podcast. Tell your friends about us. Tell your friends about The Call. Share the love. And if you'd like a company covered, you can email us at thecall, ausbiz.com.au. That portfolio is there for you to look. And next, we'll be speaking cryptos. Bitcoin had a bit of a pullback, but we've seen a lot of activity in that ETF space. We'll get a view from Ian Lowe over at Daxi. That's coming up.